Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. It's not surprising that they're starting to make that direction towards the U.S.
No one who was really making large, high-volume international payments really thought Bitcoin was a solution to that because of all the price volatility.
Most of the financial world has been batch processed on a daily basis.
Each dollar unit backing every stablecoin is represented by a US dollar equivalent held in a US bank.
What are you hearing as far as the benefits of why the stables are picking up as a form of payment?
The Web3 and digital asset industry has matured enough that some of the risks that were there maybe a couple of years ago are not as prominent. The scrutiny that was there from the federal banking regulators is not necessarily going to be as intense as it was.
Do you think it's going to still be that really broad chasm between hyper restrictive and hyper enablement? The Web3 landscape seems to be on that tipping point. The theory of what could be to starting to move towards the execution of what can be.
Bitcoin 2025 lands in Las Vegas at the Venetian May 27th through the 29th. And Fintech Confidential is there as an official media partner. We're on site with full access to over 200 speakers, breakthroughs in mining, lightning and scale, real-world use cases, institutional Bitcoin strategy, and you'll hear from folks like Michael Saylor, Elizabeth Stark, Jack Mallers, and Senator Cynthia Loomis. There's no fluff, no noise. This is where Bitcoin and digital assets get real. Your pass is waiting at fintechconfidential.com/BTC. So prices are rising and seats are moving. So be there at Bitcoin 2025, Las Vegas, Nevada. Embrace the game theory.
Welcome to Web3 with FTC. If you're asking how blockchain, crypto, AI, even quantum computing fits into your business strategy, this is built for you. We talk with the builders and the decision makers who are doing the work. You'll hear smart conversations, straight insights, and no filler. Whether you're a founder, an executive, or just trying to stay ahead, this is where real talk meets real tech. I'm your host, Tedd Huff, and thrilled to welcome our newest contributor, or as we like to call them, confidential informants. And his name is Robert Musiala. Rob is the co-leader of the Web3 and Digital Assets team at BakerHostetler, a U.S. law firm that is more than 1,000 attorneys, recognized for helping clients address complex business and regulatory issues across digital assets, data management, and emerging technologies. Now, Rob brings to us decades of experience in blockchain law, regulatory compliance, and digital asset investigations. And he's the lead author of the Blockchain Monitor blog, where he breaks down the latest trends and legal developments in crypto each week. And today's format, as you can imagine, is probably going to be a little bit different. So we'll be talking about what happened in the month of April 2025, and I'll be giving you some of the strategic signals with absolutely no fluff. And Robert's going to be nice enough to bring the structure, compliance, and legal backdrop to all of this. And today's topics, we're going to be covering payments, capital markets, regulation, enforcement, threats, and close with strategic outlook. So let's dive in. Robert, thank you so much for joining me as one of our first confidential informants on Web3 with FTC.
Thanks for having me on the podcast, Ted. Happy to be here.
So, you and I, we were prepping, going through all this stuff, just trying to pick the good stuff out of the blogs you all do, as well as some of the things that are going on in the marketplace. And I think it's important for people to understand that this has become a competitive advantage for a lot of fintechs when they integrate into this technology, whether it's stablecoin, crypto as a service, and any other loyalty-based items really start to make a big difference in it. But of course, it always comes with some fun things like licensing and registration and cross-border things we have to think about, which then, of course, brings in the compliance and the regulatory pieces.
I've been saying this for a long time. This is a borrowed quote, but in financial services these days, you're either protecting the past or building the future. And I think more and more building the future means figuring out where blockchain, Web3, and digital assets fit into your business model. And so, I think it's relevant anytime that we see a traditional financial services company taking steps to integrate with a crypto native company. And then anytime we see the reverse, a native crypto company taking steps to integrate with a traditional financial services company, and we're seeing that more and more. As you mentioned, we publish this blog every week. We've been doing that for 7 years now. And one trend that I've observed over the years is more and more often we are reporting on developments where we see this pattern occurring again in both directions, both TradFi taking steps to integrate with crypto and crypto taking steps to integrate with TradFi. The recent development you mentioned, I think has a lot to do with the continued trend that we're seeing in the marketplace and the expansion of that trend, really.
I think the piece that makes this one stand out is, Kraken is using this enabled spending of crypto at about 150 plus million merchants across Europe and the UK. And not only that, but they're supporting over 300 currencies, whether it's digital assets or traditional fiats, they're supporting all of those. So it's not surprising that they're starting to make that direction towards the US.
Another trend that I've observed over the years is, and this is something I say often, is that, I've never thought that crypto would ever replace the traditional financial system. Instead, it's going to become more and more integrated with it. In other words, if you think about it, we have a lot of different methods through which we can pay people today. We have ACH, we have wire transfer, we have credit card, we have debit card, and other methods. And crypto is just becoming one more method to add to that list. So I think, the development you mentioned is really targeted at merchant payments. And that's one sort of vector that is moving pretty quickly in the fintech space, is how do we make it easier to pay merchants? And so, I think that problem is something that is being addressed. And then similarly, there's a parallel but related problem that has always been out there, which is for crypto holders, for those who prefer to hold their money in crypto, how do we make it easier for them to pay for things without having to exchange their crypto for fiat first? And I think anytime we see announcements related to crypto debit cards or other sort of traditional fintech payment mechanisms that allow you to pay at traditional fintech point of sale systems or online portals, but behind the scenes spending your crypto, we're seeing a race to address that need, where crypto holders want to spend their crypto without having to go through the step of exchanging first, and then merchants want to just be able to accept different types of payments and reach a larger audience.
Well, and the merchants they just want their money. That's really, they just want their money, and we've heard a lot of things this last April related around stablecoin. That seems to be picking up a lot of momentum. Coinbase and PayPal, they've done a little deal together that offers rewards for using the PYUSD. They're waiving some fees. There's a whole bunch of fun stuff that's going on around that. And I know we didn't talk about this, but I had to bring it up because it came up on the last day of the month. I thought it was very interesting also that Ripple decided to place a bid on Circle the last day of the month. But, that to me just shows how frothy the waters are getting around stablecoin and how important they're going to be moving forward with those things. Rob, what are you? Is that just something that's going on now, or is there something deeper that you're seeing as well?
a little bit more to it. And, for those who are working in this space on a day-to-day basis like me, I think this is more common knowledge, some of this stuff. But for, those who are working in fintech, but not necessarily crypto, who are not living and breathing this industry every day, some of this stuff hasn't really come to the mainstream. So I'm glad that we're talking about it. But, really behind the scenes driving a lot of this is the pending legislation that's being discussed and circulated in Congress that is broadly referred to as the Payment Stablecoin Act. And that would be a law that would create a very sophisticated and detailed regulatory framework for stablecoin issuers here in the United States that would include various very smart protections, things that a lot of the U.S. stablecoin issuers have been doing for a long time now, but things like ensuring that each dollar unit backing every stablecoin is represented by a U.S. dollar equivalent held in a U.S. bank or qualified custodian, and that those accounts are audited on a monthly basis audited by U.S. public accounting firms, things that make sort of the consumer a lot more comfortable using stablecoins. And all of that it has really underpinned what some people are calling the stablecoin wars right now, because you've got this in the background pending legislation. A lot of people keep saying we will get a law passed very likely in 2025. It could be sooner, could be later, but by all counts, many people say that they expect for that to happen this year. And so we're seeing companies preparing for that. So we're seeing the current stablecoin issuers that have already been in the market for a while are starting to get a little bit more competitive. Also starting to, in some instances, cooperate a little bit more to sort of support each other in the market. And then we see new players getting ready to enter the market. And I think we'll talk a little bit more about that with things like the state of Wyoming or a Wyoming-based bank that has recently tested and issued a stablecoin for themselves.
Bringing us back to the payments piece of it. What are you seeing or what are you hearing as far as the benefits of why the stables are picking up as a form of payment? There's many different kinds of stables, and we're not going to get into the differences between them, but the stable coin is almost equivalent to a digital dollar. But why do you feel or what are you seeing that has garnered the attention of it so much so outside of regulatory, outside of those things? What are some of the things that are making it appealing to the powers that be, let's say?
Sure. Well, I mean, as you know, and anyone who has observed and worked in the fintech industry has known, payments are clunky. Historically, have been relatively clunky for a long time. And, the technology has evolved over time, but we still have instances where, international wires have trouble clearing on time, where, companies feel like they're paying way too much for payments. There are too many intermediaries involved in processing payments. And stablecoins being powered by blockchain really do solve a lot of those problems. Fundamentally, blockchain in many respects is about removing intermediaries. And so when we talk about payments, that means removing all the corresponding banks that are underlying and sit behind any payment transaction, any electronic payment transaction, especially international, and streamlining that so that you're having those payments cleared by a blockchain. Now, of course, when we were just talking about Bitcoin before the idea of stablecoins came along, no one who was really making large, high volume international payments really thought Bitcoin itself was a solution to that because of all the price volatility. And then you enter stablecoins that attempt to solve that problem by saying, hey, we're creating a digital asset that functions just like Bitcoin in terms of its transferability and its accessibility on a blockchain network. And each unit is going to be backed by a real dollar and a real bank account audited by a U.S. public accounting firm. Now, that to me, that type of stablecoin, a fiat-backed stablecoin, so to speak, is, in my view, one of the innovations in this industry that really excites me the most, because it solves a lot of these fundamental problems in payments that you and I and others that have been working in fintech have been dealing with, for our entire careers, by making them faster, near instant. There's still some issues with some of the networks, but really a lot faster in most cases than existing methods. And then, especially from an international remittance standpoint, a lot less expensive. And then fully transparent on a blockchain network so that everyone knows, when I'm paying you, you know that you received it, and I know when you received it. And we're both looking at the same record of that transaction. Those are some of the things that I think excite fintech professionals and businesses working in the payment space, or businesses looking to accept payments, about stablecoins. And then we can also talk about some of the advantages for actually just the merchants. But I'll pause there.
You're building a fintech product. You want to offer digital assets, but wallets, that's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Defense. They provide wallets as a service that's API first, multi-chain by design, and secured with MPC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Defense. MoonPay scales wallets securely with Defense. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Defense to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Defense wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Defense, secure wallets built right.
One of the things you left out that is something that gets me most excited is really the ability to programmatically have things happen based upon a trigger, or based upon a rule, or based upon some action happening, or a time period, like all these different things. So instead of having to have a person there or waiting for the next cycle to happen, is most of the financial world has been batch processed on a daily basis. A lot of that starts to go away. And I think that is really interesting that we've been able to do that.
I agree. And I think that will be the next phase that we see. Once we get a stablecoin act passed into law and businesses become more comfortable with stablecoins, I think one of the next phases is going to be a lot of experiments with, what you mentioned, what folks call programmable money, where, payments are made instantaneously upon the occurrence of predefined events. And that theoretically could unlock a lot of liquidity in the financial system.
So as we talk about stable coins, it brings us back, and you even mentioned it, we really didn't look at Bitcoin as and I shouldn't say we, but Bitcoin has not been very frequently looked at as a means to make a payment. It's looked at more of an asset, and we can go into all that fun stuff, but it hasn't been a really good means to do a transaction. And I think this is why, the stable coins give you that nice bridge between the crypto native and the traditional finance side of the house. But I would be remiss to state that in April, Bitcoin finally made it back up in the $95,000, $96,000 area. What are some of the other things that you're looking at, that you're seeing, especially when we start thinking capital markets type stuff? And we can start with the Bitcoin and then move from there.
crypto and digital assets, certainly over the last month and also just over time, appear to be becoming more and more intertwined with traditional finance. And so we're seeing that same theme play out in capital markets. Now, I always say I'm not an expert on the Bitcoin price, so I'm not going to opine on that. But what I will say is that, more on a lot of occasions, it seems to be tracking what's happening in the U.S. equities markets. And so that itself, is a potential sign that the crypto markets and the traditional capital markets are becoming more and more intertwined. And to your point, some examples of that have been some of the traditional players launching crypto-based ETFs, and that's absolutely been a theme in April and over the past several months.
Well, yeah, and so even in April, I know we're talking a lot about Kraken, but they did a lot this month, right? So they decided to launch into the traditional markets. They're offering over 11,000 plus US listed stocks, ETFs, FX futures. I mean, it just keeps going and going with that one. But US isn't the only place that things are changing, right? So in Hong Kong and Canada, they both approved some ETFs, Ethereum and Solana. But the part that I thought that was really interesting is that we've started to see the staking and the lending of digital assets starting to roar back. And so what do you think is really driving that desire to on those return side of the house? Does it have anything to do with the stablecoin stuff that we talked about?
I think it's mostly separate in my view. I think that the similarity again is the continued intermeshing of the traditional and Web3 markets. I think the staking point that you raise is to me the most interesting, and that's a relatively new development. And as you mentioned, we saw some developments in Hong Kong where there was some regulation passed to provide the market with some clear rules as to how to do this in a way that was going to be met with approval by the financial regulators.
If your provider doesn't allow you to manage all your assets in one place, we're already starting to see that people are behind. So that's going to be a big piece of it. And of course, you got to have the trust and we're going to move into the next segment, which is the regulatory side of the house. And of course, if you have all that stuff in one place, that means you have to make sure you've got all your ducks in a row and are being in the regulatory sites in a good way. I think it's been really good. And I'm going to come back to the U.S. again. We'll just land back in the U.S. Heck, let's go to D.C. and talk. All of the acronym agencies have really decided to roll back or to simplify or to make it a little bit easier for these digital assets to move forward. And I really like the direction this is going to go. At least my perspective, I'm liking it. But you started to talk about it earlier, and I'd love to go a little bit deeper into the SEC's guidance on stablecoins and, it being US backed, one-to-one redeemable, requiring liquid reserves, not securities. Like, help us uncover that a little bit more.
In April, the SEC published its own set of guidance, and this is from the SEC's Division of Trading Markets, I believe, addressing what they call covered stablecoins.
It makes me start to wonder, are they already expecting to provide returns on stables? Like are they, it's not like they're preparing for that type of a position to be placed in.
Well, that's an interesting comment. I hadn't thought about it that way. From my perspective, and just to give a little bit more context, a covered stablecoin, according to the guidance, if it meets that definition, generally would not be considered a security. And that's the whole point of the guidance, is to give the market some confidence that if you're doing stablecoins the right way, you're not going to get an enforcement action or a subpoena by the SEC. And we talked about the Payment Stablecoin Act before. I think another smart thing that has been done by the SEC here is that they're getting ahead of the Payment Stablecoin Act a little bit and giving the market a little bit more comfort while some of the similar definitions are worked out in what will eventually become a law. And maybe giving, in some respects, giving the legislators, some advice as to what that definition, might look like in the law.
Just kind of giving a little bit of guidance, trying to shepherd it along. I mean, that there could be worse things that go on with that. But the other thing that also happened, again, just keeping in alignment with some of our federal agencies. I mean, Federal Reserve rolled back their restrictive guidance and really got it really aligned with OCC and FDIC. And this month I've had the opportunity to participate at the NACHA conference in New Orleans, Louisiana. And this seemed to be a really big thing that they were talking about there is the guidance that has been adjusted by the OCC and the FDIC around these types of things really seems to be opening up a number of opportunities and making these financial institutions feel a little bit more comfortable with bringing on digital assets. Now, again, I said a little bit more comfortable, not a lot. It's not like they're going to open the floodgates, but they're feeling that way. What other things are you seeing with all of these rollbacks and the perspectives that others are having from this?
Well, I think the development you mentioned, where we now, as of the month of April, have all of the major U.S. banking federal regulators essentially in alignment in saying that the former process of a bank needing notice or a letter of non-objection, in other words, permission, to engage in crypto-related activities, that guidance is gone, and banks can now engage in crypto-related activities at their own discretion, but also subject to the normal supervisory review process. So a bank will get reviewed, and they'll get reviewed for a lot of different things, and crypto will be one of those things. And I think part of the press releases that announced these developments noted that the Web3 and digital asset industry has matured enough that some of the risks that were there maybe a couple of years ago are not as prominent. And so, these risks can be addressed in the normal supervisory process now.
If the systems and the market itself has matured a lot, though I believe that the understanding from those who regulate it probably has matured more so than the actual products and technologies. So that one, I see where you're headed with that. But, the thing I want to talk about next is really, we look at this, we're talking about federal regulators, right? And federal regulation. But in the US, the states can do all sorts of fun stuff all by themselves. And, the one that has come to light, especially this month, was Wyoming. They've decided to launch the YST. It's in testing. They're running with that. And then on top of that, you've got Custodia and Vantage that launched their first bank stable coin. I mean, there's so much stuff that's going on at the state level right now. I'm starting to feel, and you and I kind of talked about this as we were prepping over the last few weeks, because I'm starting to feel like I wonder if we're going to start looking at digital assets the same way we look at money transmitter licenses, how it's a state by state variation. What are your perspectives, and what are the things that I left out that's going on at the state level?
Sure. Well, I think first, I think the states now are going to become a lot more comfortable taking actions that maybe they wouldn't necessarily have taken in the absence of the recent guidance from the federal regulators. So companies and then even state-based agencies now have a little bit more comfort that the the scrutiny that was there from the federal banking regulators is not necessarily going to be as intense as it was a couple of years ago. That opens up, gives confidence to state-based agencies as well as banks within states that are operating under state charters to take some actions that maybe they were kicking around from like an research and development and new product perspective that they were afraid to launch a couple of years ago. And now, I think some of that fear has been lifted. And so I think in large part that it has triggered some of these developments like the ones you mentioned in the state of Wyoming.
So when I look at Wyoming has been very digital asset forward for a really long time. And then you look at a state like New York that has been very, very super restrictive. And the other state that I'm still trying to figure out where they're going and what they're doing with digital assets is Illinois. But where do you think it's going to still be that really broad chasm between like hyper restrictive and hyper enablement? Like, is that something you're seeing and as you look through all of this stuff?
I think we're going to see a real mix across the board. I think we're going to see, on one end, like the state of New York, very restrictive licensing regime. On another end, like the state of Wyoming, very open to innovation.
You couldn't have picked any two further opposites out of any of it.
And we'll see everything in between. We're going to see everything in between. And I think over time, it may be that some of the states that are slower to act may sort of observe what the results are in the more restrictive categories, less restrictive categories, and then sort of follow suit. And so, just as a couple more recent examples, some states have been discussing their own state-based strategic Bitcoin reserves. Arizona apparently is pretty far along in that process, from what I understand.
But it's been really interesting to see how those types of things. I think Texas is another one that has it on the books as well. I think we're going to see a lot more folks do that. And
this market is growing. It's very big. It's not just a one size fit all market. So, as some more examples, strategic Bitcoin reserve could be one area where state focuses on. Another could be stablecoins like Wyoming. Another could be licensing for exchanges. Think New York.
Oh, yeah.
Another area could be the mining sector. And Texas has been very receptive to the mining sector. And there are, I'm sure we could come up with many more. And I think different states, maybe even based on their own sort of economies, may pick and choose which areas in this market that they want to regulate more heavily versus take more of a light touch approach.
A lot of these states and a lot of the players in the space aren't waiting for an act of Congress, right? They're looking at the frameworks that are already there, that have already been working. They're taking guidance from the enforcements that have happened over the years and really allowing people to find their way, whether they're navigating just based on the regulatory tone shifts, the enforcements, kind of managing through that, because it doesn't mean that it's less responsibility when you have everybody on the same page. It just means that everybody is starting to look at it from the perspective of, okay, so we know it's going to be here. We know that we're going to have to protect consumers and businesses and make sure that our economy keeps moving. And I think a lot of them are really starting to see it from that perspective.
But coming back to kind of your original point about Wyoming, the concept of a state getting ready to launch its own stablecoin, that's groundbreaking. That is really something that is, we haven't seen anything like this before, and that's fascinating. And then also being the home state for what will very likely be the first bank, chartered bank to issue a stablecoin. And I'm pretty sure we're going to see many more chartered banks issue their own stablecoins in coming years.
It's funny, and I appreciate you bringing us back to that, because I've been watching Custodia and I've been watching Wyoming for so long, and as probably many in the industry have been, that that big change sometimes just is kind of like the obvious next step, right? So it doesn't feel as climactic as when you step back and you look at where it started and where it's at today. That really sets the stage and really gives us a good perspective to look from. I don't like to talk about all the negative stuff, but I've got to bring it up. And of course, because we have you from Baker here, I do have to talk about the legal, regulatory, enforcement whirlwind that we've had. But I thought it was really interesting that in April alone, SEC either dropped or settled with Ripple and Coinbase and Kraken and Immutable and Yuga Labs and Gemini and Consensus and Robinhood and OpenSea. I could probably go on for another 5 minutes of listing all of the enforcements that were in flight that have just been resolved. I've got to imagine that you're seeing and you're hearing a huge, huge sigh of relief. What is your perspective on this enforcement environment now?
Well, like being a payments professional and fintech and Web3 attorney for, over 12 years now, and working my entire career in compliance and investigations, I think what I could say big picture is that, the regulations are always changing. So, you've got to be nimble, especially in fintech and Web3, because they're changing. They always change rapidly. And you've got to keep up on those changes so that you can understand the current environment and plan for the future. And we have seen a real sea change. No doubt about it. I think that is, at this point, based on a lot of those actions you just mentioned, it is 110% clear to everyone that there has absolutely been a sea change in the enforcement environment. And that obviously opens up a lot of opportunities and, allows businesses to pivot from, sort of what may have been a more defensive stance to more of an offensive stance, to try to capture and be more aggressive, try to capture some of those market opportunities that maybe they were discussing in years past, but were, a little bit too timid to pull the trigger on for very good reasons. And so I think that, that change in the marketplace has at this point become absolutely 110% clear to everybody. There's no doubt that there has been that pivot. And I think that is, one of the things we can absolutely say coming out of the month of April, with all of the actions you mentioned being dropped over the course of really March and April.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
That makes a lot of sense. And, New York has always been very regulatory or enforcement heavy. I mean, just this April, they fined Block $40 million for some AML violations. I don't know. It's quite a bit, but if you look at the total assets that Block has in digital assets, it's not really that much.
Part of the message with that action is that the state of New York, as we would have expected, is going to continue to police this industry and is going to continue to fine companies that it thinks are violating its New York BitLicense regime, and is going to continue to take, in particular, anti-money laundering violations very seriously.
In the early days, and even some conversations today, you still have people saying that cryptocurrency is for criminals, cryptocurrency is for the scammers. I think we've moved past that, but this is just another area where the providers and the technology and the fintechs in the middle can get a little bit over their skis and maybe not meet the criteria that is there, and perpetuate a little bit of that. Hopefully it doesn't keep going, but you have the hacks and you have the social engineering and you have all these other different things that the losses and the fraud and the scams that go along with it are crazy. But one of the things that you wrote about in the blog is that crypto theft totals, right about 1.63 billion-ish. I'm using a ish area. I thought that was really interesting because if you look at it, that's about 1% of the total market cap for Bitcoin itself. So that's a lot of value that's been stolen.
Yeah, it's really a staggering number. And, as you know, Ted, like one of the things I say all the time is that, in my view, the biggest threat to the crypto industry becoming adopted by the mainstream is not regulation. It's actually hacks and scams and other related threats. And I think a lot of the data that we saw published in the month of April really underscores that. So 1.3 billion worth of crypto lost in Q1 2025 alone. So just the first quarter of this year. And as you mentioned, that representing 1% of the entire Bitcoin market cap. So that's a very big number. It's a very big vulnerability, frankly, of this growing digital asset based financial system.
I mean, these things are happening on DeFi platforms. They're happening through, social engineering where someone says, hey, take a picture of the QR code for your wallet. And like, there's so many different things on. What are some of the ones that you came across in doing the research that just, you're like, wow, I would have never thought about that?
Generally, take a couple different forms. So, hacks of exchanges, that's always been a threat. And, we, had the recent Bybit hack. I believe that was in March, not April, but, that was at that time, became the biggest hack, of an exchange ever, happening in 2025. We've got scams, to your point. That's been a growing concern. And, there are even, by many counts, large operations overseas that are all fully with like lots of people dedicated to proliferating these scams where they're just looking to trick people into sending them their cryptocurrency or trick people into giving them credentials that allow them to hack someone's cryptocurrency accounts or a company's cryptocurrency accounts. And then we've got DeFi hacks. So just a couple data points from April alone. In April, $90 million worth of crypto was stolen from DeFi platforms. Some examples, we had hacks of the Abracadabra Money DeFi platform, the Zoth platform, and more recently the Loop Scale platform. These are all popular DeFi platforms that were hacked for 13 million, 8.4 million, 5.8 million in crypto. Not enormous, but enough to really
It adds up.
Yeah. And diminishes trust, and I think that's another big factor.
Yeah, from my perspective, it makes sense. Like the folks who are more technologically or technical savvy would be less prone to some sort of malicious attack or hack or something like that. But it seems to be, at least for right now, and maybe it's vibe coding that's causing this to happen, but they're coming through API hacks, they're coming through Python packages, like all these different things that are coming on that you would think that someone who understands the technology at that layer would know what to look for. It like, that's surprising to me.
Yeah, and that's an example of a growing attack vector, and I think a sign that some of these attacks are becoming more sophisticated and looking to target more sophisticated victims, people that are likely to use crypto or maybe likely to hold large amounts of crypto. But to your point, in April, we reported on 2 pretty sophisticated hacks where the hackers didn't attempt to hack the victim directly. Instead, the hackers altered and inserted malware, crypto malware, into popular programs that are popular among crypto users to download and deploy in various applications. So, that's a sign that you see hackers targeting more sophisticated users, whether those might be companies that are building their own crypto infrastructure, like we talked about the proprietary staking services earlier, or maybe they're targeting more sophisticated users who are more likely to hold crypto on their own rather than on a third-party exchange, and likely to hold, frankly, more crypto, higher volumes. And obviously the hackers are interested in that.
Oh yeah, the bigger the honey pot, the more bears will come trying to get to that honey. So totally get it. We've covered a bunch of stuff today. Obviously, we can't cover everything that happened in April, but these are the ones that we really identified and thought were important to bring up. Because one of the things that's important to note is what we've noticed in April is that the Web3 landscape seems to be on that tipping point from the theory of what could be to starting to move towards the execution of what can be, and really is giving us the next steps of what to do and how to get there and how to enable it. And I can only imagine the number of announcements that come out in May are just going to continue to come, especially with these historic changes that we've had so far. Rob, what are some of the things that you think we might see happen in May that were just signals being sent to us in April?
Well, I certainly think we're going to see this continuation of developments in stablecoins, and I think we're going to see more people enter that market. The players that are already in that market looking to launch new products. Maybe there's products that are getting ready to be launched behind the scenes that could make a large impact. But I absolutely think stablecoin applications, integration between traditional crypto firms, Web3 firms with traditional financial services firms will absolutely continue to be a trend. I think it'll be interesting to see how the regulatory environment in the US continues to evolve. As we talked about, we've seen a clear 180-degree shift, a clear sea change. And then, will we see more developments along those lines in May? Probably. What form will they take? It's hard to say. And so that will be interesting. And then at some point, we're going to the regulatory environment should shift focus from sort of dismantling the policies of the prior administration to then building kind of the foundational policies of the current administration. We're seeing some of that with the SEC statements that we talked about today, but I think we're going to see more and more of that. The SEC is going to continue its roundtables where it's receiving input from the public on what
that round. So the last roundtable of April, I did watch it live. It was very informative. If you watch it on YouTube, go ahead and bump it up to like 5x. That'll get you there, or just copy the transcript, throw it in the chat GPT and read through it. It'll help you out, and it'll save yourself at least 4.5 hours. And well, folks, that's it for this episode of Web3 with FTC. If this discussion about Web3 got your attention today, that's great, because there's more from where this came from. So go ahead, head over to YouTube, Spotify, Apple Podcasts, or wherever you listen, and hit that follow button. And if you want to stay plugged into everything we're doing, and everything we're tracking here, go over to fintechconfidential.com and sign up, because that's where all the deep dives live, as well as the future episodes. You'll be able to learn more, and be sure to share this with someone who's serious about where fintech is going. And as always, keep moving forward.
As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.